assumptions to manage that. How
Um,
do you manage that circumstance?
MD, say it again. And I think, okay, since it's 8:30, or I'm sorry, it's 5:30 Pacific time, so we'll get started now. I know there's a couple of people who are probably still getting on, but what I was, as I said in my message, I'll tackle a couple of questions. If there are questions regarding the readings, um, now. If they're not questions regarding the readings, then I'll ask that if you can hold it to the very end of class, and then I'll try to tackle them all at the end of class. So MD, is your question regarding any of the readings right now, or do you want to talk about it at the end of class?
Oh, just volatility. I feel like when I was reading and I was going through your materials, like uh, how to make decision when the market is in the bottom, so that you don't lose you get confidence and you get that like passions that you can make that decision in that circumstances. How to get that confidence?
Yeah, so that's what this class is going to be all about. So let me go through the class, and then we'll talk at the end, and hopefully between now and the next hour from now, we'll talk about some of the things that you can hopefully think about as ways to get confidence. But I will say, look, I'll just make one comment, which is I think that when you look at the long-term history of investing, and not get too caught up in the short term. And if you can keep your eye on the long-term picture, that I think will go a long way in terms of giving you the confidence to, kind of stay the course. Here, I'm going to start the slide share right now. Can everybody see? Oh, you know what? Sorry. Hold on 1 second. Let me try that again. Okay. All right, can everyone see the slides? Take that as a yes. Okay. All right, so let's get started. So welcome back to week number 3. This week, the focus is really going to be on, the main topic of the class is how to deal with volatility, and then how to think about timing the market, and then, the concept of Mr. Market from Benjamin Graham, which I think is, still to this day, a very powerful framework to keep in mind. And then, like I said, at the very end, I'll try to handle all the questions at the end. If there's any IT questions or you can't hear me or something like that, of course, please feel free to interrupt me while I'm speaking. So again, topic of the question is the problem of market volatility. We talked in the last class, right? Professional investors are, in many ways, they're handicapped, right, by their incentives, right? They have an incentive because they get paid based on performance, and then they have an incentive because of career risk not to underperform. And so their incentives really force them to own what is quote unquote working today. And then, we talked about the equity yield curve as the concept of what we can use as a way to capitalize on this behavior. And what, hopefully what you took away from it last week is that we really, the equity yield curve concept forces us to gravitate towards investments that may currently be out of favor, right? Obviously, if everything is going great and it's working, everybody wants to own it, and it may not actually be the best investment. The problem is, if you're owning stuff that's out of favor, you sometimes have to deal with volatility. And it's, when you're dealing with volatility, it's sometimes hard to stick with your plan. It's sometimes hard to maintain a certain level of conviction. So the question that we're going to try to tackle today, I think is kind of the question that MD was alluding to, is how do we adopt the right long-term perspective? And, really, how should we deal with market fluctuations? So I always think this is really funny. But I also think it's really true. You know, the Mike Tyson quote, everyone has a plan until they get punched in the mouth. And, you know, what we'll come to realize is that, you know, if you're going to be a long-term investor in the stock market or really any market, you will get punched in the mouth. You're going to have bad times. And really, how do we create a plan that can deal with that? So the first reading of this week was Fear of Crashing. It was an article written by Peter Lynch. He wrote it as part of, he was writing a column for Worth magazine after he left Fidelity. So he managed the Fidelity Magellan Fund from 1977 to 1990, where it's a phenomenal return, 29.2% annual return over that period. He wrote two books called, one was called One Up on Wall Street and the other one was called Beating the Street. If you've never read those, I actually think they're pretty good. And so, you know, you might want to think about it. And then, like I said, he also, in the 90s, wrote a column for Worth magazine. You know, he was a Barron's you know, he was a Barron's Roundtable member and things like that. So you can find some of his old interviews and things like that online. And then I posted a video, it was optional, just of a speech he gave at the National Press Club. You know, I think it was in 1997. So what does Peter Lynch say? Well, he says that stock prices will fluctuate significantly every year. And we as investors really just need to accept the fact that prices for individual stocks will move significantly. This, you know, I think this is such an interesting fact. I just kind of quoted it directly, right? What does Peter Lynch say? You know, do you know that what the range is between the high and the low and the average stock in a given year? It's 50%. And I think if you told most people that comment, they wouldn't believe you, right? It says, so most stocks fluctuate 50% from the top to the bottom every year without any fanfare, right? We don't notice it because it gets lost in the overall index performance, which doesn't necessarily fluctuate 50%, but the components underneath it are fluctuating significantly all the time. Interestingly, you know, here we are roughly 30 years later, and the average S&P 500 stock still fluctuates greater than 50% every year. And this applies for even the largest, most well-followed companies. And these fluctuations kind of persist every year. And what I think is interesting, and hopefully what you'll see, is despite these large fluctuations, you know, no active manager I know is putting up returns anywhere close to what these fluctuations would suggest. So just keep that in mind. So let's look at it, right? This is maybe a little bit dated, but you know, I put this together pretty recently. So what is the last 52-week range of some of the largest companies? So let's take a start. We'll start with NVIDIA, right? It's got a $4.7 trillion market cap. So, you know, it's quite a large company. In fact, the largest company. Its 52-week high was $195. Its 52-week low was $87. Its range is 125%. Number two is Microsoft. The range between the high and the low. Again, this is just the last 52 weeks, the last year, 61%. Apple, 53%. Alphabet, 82%. Amazon, 50%. Meta, 66%. Broadcom, 171%. Pretty good if you bought it low. Tesla, 130%. Berkshire Hathaway, oh, wow, only 23.8%. So I guess Lynch was wrong about one of those stocks. Oracle, 191%. So, you know, 50% on average is actually pretty low right now. And these are, like I said, you know, when you look at these 10, you know, roughly 10 companies, these 10 companies, I think these 10 companies are probably something like, you know, 40% of the weight of the S&P 500 index today. So these are the largest companies in the world. You know, I think each one of these companies has probably at least 20 to 30 sell-side analysts covering them. and they still fluctuate this much. Pretty amazing. And then, like I said, these ranges, recur every year. This isn't just a phenomenon that's happening right now or just happening this year. So again, let's look at NVIDIA just over the last 10 years. 76%, 365%. And that's not even before AI was invented. 127%, another 127%, 128%, 87%, 196%, 187%, 168%, 253%, 213%. Quite dramatic. Microsoft, I won't call out all the numbers, less volatile, but still pretty significant ranges from the high to low every year. Apple, again, maybe a couple of years where they're below 50%, but a number of years where it's, at or pretty high above 50%. Alphabet, Amazon, Meta, Broadcom, Tesla. Wow, Tesla had a year where between the high and the low was 877%. Berkshire Hathaway, again, pretty rare, where its fluctuations between its high and its lows are much more moderate. I think that probably tells you something about Berkshire itself and the type of investor base it has. And then Oracle, again, definitely a few years where its high and low is less than 50%, but a number of years where, it's also significantly higher. And so when I look at a table like this, what I see? I see a lot of raw material, right? And so when I look at a table like this, and the first time I saw this table, it absolutely, completely floored me, right? But it made me think that, really, if you just actually knew a few companies really well, would create tremendous, investment opportunities. And, putting aside, even if you kind of incorporate short-term capital gains and things like that, these would still be phenomenal returns. And what's interesting is, I don't think when we look at professional active managers, I don't think we see anyone who has returns anywhere close to, what some of these numbers look like. So something to keep in mind. So what should we do, right? And this is the question that Lynch is trying to answer. And I think his answer is basically that volatility is really the price that we have to pay to be long-term investors. It tries, the market volatility tends to shake out the weak hands in investing. And it's better to hold tight and invest for long-term. And we'll talk about this in a little bit more detail. But the next point that Lynch makes is that he doesn't think that market timing is really worth it, right? Trying to predict and prepare for most corrections is costly, right? And when people think that a correction is going to happen, they're thinking about a recession or, maybe tariffs, or they're worried about the economy, they hedge or they lighten up, right? But the problem is they don't know when to get back in. And the way Lynch says it is, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. I don't know if that's actually true or not. I don't know if there's a way to prove it, but I think the point that Lynch is trying to make is that when you think that maybe there's a downturn coming, you will, you'll hedge, or maybe you'll sell your portfolio or things like that. And then, you face a real risk, right? One risk that you face is that you're wrong and the market keeps going up and you lose out on the returns in the meantime. And I think the second risk that you also run, which I don't think he's talking about here explicitly, is that, there will be a correction, but you don't know when the correction ends and you don't know when to get back in. And then sometimes the market rebounds quite sharply off the bottom and you miss those returns because you maintain your, maybe more bearish, investment posture for longer. So he actually goes and puts some numbers to it, right? And when you look at look at what Lynch wrote, right? The difference between buying on, he looks at market timing in a couple of different ways, but I thought the first way he looked at it was pretty interesting, right? If you buy on the best day of the year and the worst day of the year, and if you look at your long-term returns, the difference is about 1%, right? What's important is this presumes that you actually know what are the best or worst days of the year, right? The next couple readings are talking about God. So it imagines if you're God and you knew ahead of time that this was the best day or the worst day of a given year, and you were buying the index. And so the actual gains, we're not God. We don't have perfect foresight, right, of market timing, even compared to the small numbers that Lynch cites would be much smaller. And so what does he say, right? If you had invested in the S&P 500 on January 1st of every year since 1965, and I think he wrote this in 1995, so for 30 years, your annual return had been 11%. If you were unlucky and you invested at the peak of every year, so you bought at the worst possible day of every year, you bought at the high, and if you did that, your annualized return was 10.6%. So most people would round that to 11. And if you were lucky and you invested it at the low, you ended up with 11.7% annual return. So basically, the absolute spread between the high and the low is a little over 1%. And to Lynch, that basically means it's really not worth spending a lot of time trying to pick the highs and the lows in the market in any given year. So he wrote this. Did I say 95? I think he wrote it in 97. So I ran this analysis. What would have happened since 1997? And so if you, again, were buying it at the beginning of the year, if you bought the market at the beginning of the year, every year from 1997 to now, you earned an annualized return of 13%. If you invested at the high, your return was 11.9%, 12%. And if you invested at the low, you made 14.7%. So let's say 15%. So the spread is definitely a little bit wider than when Peter Lynch wrote this. But again, it really assumes that you have perfect timing. So unless you do, any actual gains from trying to time the market would be much smaller. And then let's also not forget that, if you're trading in and out of the market, you're going to end up paying taxes. So that'll reduce your after-tax return. The next thing that Lynch points out is being out of the market for even a small percentage of time is very costly. And here's what he finds, right? If you kept all your money in stocks, your return was 11.4%. If you were out of stocks for the 10 most profitable months, your return dropped to 8.3%. So he's talking here about 10 months out of 40 years. So basically 2% of the total time, if you were out of the market, it was pretty significant in terms of impacting your overall realized return. And if you missed the 20 most profitable months, your return was 6.1%, and the 40 most profitable months, and you only made 2.7%. 40 months out of 40 years is only 8% of the time you would be invested. So basically, my takeaway from this is really that returns are very concentrated in the market, and we'll see more of this stuff down the road. But you really don't want to be out of the market, because if you just miss a little bit of it, it really does impact your long-term returns. So let's look at it more recently. So if I take the 40 years from 85 to 2024, the annualized return is 11.8%. If you miss the 10 best months, your return went down to 9%. If you missed the 20 and 40 best months, it was 6.8 and 3.1%. So, these numbers really aren't all that different from the numbers that Lynch was citing, even though we're looking at a different time frame that, really spans, almost 30 years afterwards. Now, if you could figure out a way, I thought this was interesting. If you could figure out a way just to miss the bad months, it'd be phenomenal, right? So your returns are better if you could just avoid the worst months. So if you can avoid the 10 worst months, your return actually increases to 11 or 15.5%. And if you miss the 20 and 40 worst months, you actually make a whopping 18.1 and 22%, respectively. I think Buffett has compounded at around 20%. So, you would have Buffett-like numbers if you could miss the 40 worst months only, and just own the S&P 500 otherwise. If any of you guys figured it out, please let me know. I'd probably love to invest with you guys. Because what we're going to find out is that there's something called volatility clustering. So when we look at the best and worst months, they all tend to happen around one another. So here are the 10 best months for the S&P 500. So you can see them all here. You can see how big the numbers were. And you can see kind of what was happening at the time. And you can also see here are the 10 worst months of the S&P 500. And you can see how bad they were, and you can see what was happening at the time. And so right off the bat, looking at this table, I think we need to make a couple of points. One is, last week we talked about, what John Maynard Keynes was saying about when the convention is broken, right? When we can't assume that tomorrow will look a lot like today. That's when you see these waves of optimism and pessimism. And so I think when you look at these tables, what you see is that the best months and the worst months all happen during periods of significant uncertainty, where again, the quote unquote convention is broken. And that's where you get these waves of optimism and pessimism driving big moves in the market. So I think, again, looking at this table, I think a couple of things that really, again, stand out. First, right off the bat, is both the single best month and the single worst month both happened in 1987. People really only tend to remember Black Monday, October 1987. I don't think anybody remembers that in January of 1987, the market was up 13.5%. So that's, that's an interesting point, right? You could look down the left, the right-hand table. March 2020 was the worst month of COVID, and you see the fourth worst return ever. But looking at the other table, April of 2020, the month thereafter was actually the second best return in the S&P 500 in history, and COVID was still very much happening. I think it's also interesting, again, looking down that table. We all think of March 2000 as the peak of the NASDAQ bubble, and sort of the start of the bear market. But March 2000 was actually a really good month for the market. It was, the fifth or sixth best returning month, in history. So, I think interesting, kind of interesting things to just keep in mind about volatility and how volatility tends to cluster and how the good months and the bad months stay together. And so you could try to miss the bad months, but you might end up also missing some of the really good months. Here's a chart, which again, hopefully shows volatility clustering in a little bit more detail. This goes back to 1985. So what you see here is, first starting on the very left-hand side is you had the Plaza Accord and tax reform. That led to some really good months. It also led to Black Monday. Then, little period of quiet. Then we had the Gulf War. Then we had a fair number of quiet years until we get to 1998 and the Asian financial crisis and the collapse of long-term capital management. And then almost as soon as that ended, we had the tech bubble, a lot of volatility there. We always remember the down months, but we don't really always remember, you had significant up months during that period as well. Then we had a few years of quiet, and then we went into the GFC. Again, a number of very bad months, but also a number of very good months. And then the GFC end is we have the European debt crisis, and then on and on and on, all the way to COVID and the, I guess what people now call the Great Inflation. So anyways, basically just goes to show that you could try to avoid the bad months, but if you try to just avoid the bad months, you're probably going to avoid the good months. And so what happens if you avoid both, right? And so if you miss the good and the bad months, it actually doesn't help that much. So if you miss the best and worst months, it only adds slightly to your returns. So if you miss the 10 best and worst months, your return increases to 12.6%. And remember, to put this in perspective, the return from just staying invested was 11.8%. And if you miss the 20 and the 40 best and worst months, you were at 12.8 and 12.6%. So again, not that different. And so, you know, what I think we need to keep in mind is, you know, these returns are slightly better than the returns that you got from just buying and holding, but these numbers are also before capital gains taxes. So after taxes, you're probably better off. You are better off just staying invested in the market and not trying to time it. And then the last thing that Lynch talks about, which I'll go into a little bit more detail because I know some people here are interested in other investments besides stocks, is when to invest in bonds. And he basically says that, you know, bonds really are not very attractive. You know, he's in the piece, he says there's a case, you know, the case for 0% bonds, why you should have 0% of your portfolio in bonds. But he does actually say that bonds are attractive only when their yields are above expected equity returns, right? You know, he says that bonds are almost as volatile as stocks, which I don't think most people realize. I'm specifically talking about long-term bonds, so think about 10-year and 30-year bonds, not short-term bonds, but long-term bonds. When you look at the volatility of long-term bonds and you look at the volatility of stocks, they're actually pretty similar. And so what does Lynch suggest? He suggests that, you know, you're better off owning stocks and selling a portion of them than investing in bonds. And in his example, he uses stocks, which at that time had a 3% dividend yield, and earnings were growing about 8%, and comparing that to 7%, you know, bonds. And what's interesting about Peter Lynch is he actually did own bonds in the early 1980s. And this is when Treasury yields were, you know, really equal or greater to what he thought were the expected return from equities. This was not in the reading. This is actually from his book, Beating the Street. But what he says is, I didn't buy bonds for defensive purposes because I was afraid of stocks. I bought them because the yields exceeded the returns one could normally expect to get from stocks. So he was really buying treasuries because he just thought that you could get the best returns from there, or you could get equity-like returns from there. And in the book, Beating the Street, which again wasn't an assigned reading, so I'm just going to tell you some of the stuff. He actually came up with an interesting rule for when to buy bonds. And what he says is that you want to buy when the yield on long-term government bonds exceeds the dividend yield of the S&P 500 by 6% or more. Sell your stocks and buy bonds. So that's an interesting rule. We'll talk about it in a later class, how he might have actually come up with this rule. But let's actually look at what the results were. So from 1980 to 1982, because we don't know exactly when he bought bonds, but we know it was around this time. So the 30-year Treasury at that time, you know, the yield was about 12.5%. The yield on the S&P 500 for perspective was 5.3%. So very different world that we live in today when, you know, 30-year treasuries now are about 4.6%, and the dividend yield on the S&P 500 is all of about 1%. So let's see, how did they do? So both the S&P 500 and, you know, long-term treasuries both returned about 14% total return over the next decade. And if you look at the full 30 years, the S&P 500 did 11% and treasuries did about 12.5%. So, you know, you would say that treasuries were actually better. But I just said at the top that stocks were better, right? And why? Well, stocks did better than bonds on an after-tax basis. So one of the things to keep in mind about treasury bonds is that the interest on U.S. treasuries is still subject to federal tax, as taxed as ordinary income. And dividends and capital gains are taxed at much lower rates. So that's why I said that you probably would have still been better off owning bonds. And today, with, you know, like we said, about a 1% dividend yield on the S&P 500, you know, Lynch would say that you really need treasuries to be above 7% for them to be more attractive than stocks. 1 second, sorry. So that was Peter Lynch. So let's move on to, all right, let's move on to even God would get fired as an active investor. This is by a gentleman named Wesley Gray. He's started a company called Alpha Architect. I think he's a PhD. He has a finance PhD, if I'm not mistaken. He founded a company called Alpha Architect, which is basically used his research to come out with a bunch of ETF products. And then, as you can see here, he's written a couple of books. And what I thought was most interesting from this article is really that a crystal ball doesn't really help you very much. And if you had a crystal ball of what were the best possible investments going forward, you'd still have to stomach a lot of volatility, right? So knowing the best stocks won't help you avoid large interim declines. And he did an interesting study, right? And if you read it, you'll see that he explicitly keeps saying that these results are not, this is not, these aren't replicable. It's the study is itself actually engaging in look ahead bias. And so what he's basically saying is that every point, if you knew what the best stocks were going to be 5 years from now and you bought them, at the very beginning, how would you perform, right? And, what we see is that, as we saw from Peter Lynch, right, individual stocks have large fluctuations. And what Wes Gray, he goes on to say is perfect foresight has great returns, but still gut-wrenching drawdowns. And, again, from our other readings, what do we know, right? Professional investors worry about career risk. And they worry about career risk mostly because clients can redeem their assets pretty quickly. And so it really makes it difficult for even professional investors to buy and hold some of these great stocks through maturity effectively, if you want to think about it like this. And so what does he say, right? So what Wes Gray says is that an active manager who's clairvoyant, i.e. God, he would get fired many times over if he was managing other people's money. And so when he did a study, right, the God portfolio of owning the best stocks massively outperforms the market, 29.5% versus roughly 10%. So I think most of us would be very content being God and having those kinds of returns. But the problem is that we experience numerous declines where our portfolio declines by more than 20% along the way. And here you can see, again, this goes all the way back in time, but you can see that even knowing the best stocks, right, you have at the very beginning a decline of roughly 75%. That's, from the Great Depression. But even if you go all the way to more modern times, right, you see declines of 40%, you see declines of, again, 40%, 30%, 30%, lots of 20% type declines. So, some pretty ugly declines, right? And what's interesting is that, the blue is the declines of the portfolio. The shaded red is the declines for the S&P 500. And so, in terms of magnitude of owning the best stocks, your declines are not always all that different than the overall market. And you tend to decline at roughly the same times as the overall market. What I thought was interesting, just looking at this chart, is that, when you do own the best stocks, they do seem to rebound faster than the overall market. And, that may have something to do with just them being good companies and being able to grow through some of these near-term issues. But I think this is a very interesting chart. And then going next, he also does it as if God were a hedge fund manager, and, God, doesn't necessarily make a great hedge fund manager either. So, going long the best and short the worst stocks still leads to some trying times. And what does he say? Is the relative performance of God's hedge fund is often abysmal, right? The passive index would eat his lunch on multiple occasions, often getting beaten by 50 percentage points or more on multiple occasions. Okay, well, let's look at the chart. So here you can see, now, obviously here the declines are less severe, right? But you're running a market neutral portfolio. So for every dollar you're long, you're a dollar short. So that should be expected, but even in a market neutral portfolio, very few market neutral managers can tolerate, 20%, even 10% type losses. Most market neutral hedge funds, have risk limits where they tolerate drawdowns about 3 to 4%. So you would definitely get fired if you were running this portfolio over time. And here you can see how the relative performance stacks up. So this is looking at the 1-year relative return of the God portfolio versus the S&P 500. And what you can see is there's lots of periods of time where this perfect portfolio still underperforms the overall index, and you lag the index significantly. So let's look at how we would have done more recently. So Wes Gray wrote this article in 2016. So how would have God done after 2016? So if I looked from 2016 to 2021, we would have done a whopping 45.7% annualized return, which is amazing, right? Over the study, I think the number was 29% and change, so pretty significant. But that portfolio would have declined a little over 20% from its peak. And if we look at even more recent time, 5 years ended, June of this year, we would have done 47.1%. So also pretty great. But, the portfolio would have declined 26.5% along the way. So, really what this article does, he comes to a similar conclusion, that I think Peter Lynch comes to, right? Which is that volatility is largely unavoidable, right? This is the price that we have to pay for good long-term returns, is we have to tolerate volatility. And really, even if we know what are the best or worst investments ahead of time, we really can't avoid volatility. It's just a fact of life, right? So even with great long-term investments, we have to tolerate some pretty trying times. So that was the key points that I think were most important from the Wes Gray article. And so then we go to the next one, right, which is even God couldn't beat dollar cost averaging, right? And you guys will think I have some fascination with God or religion, but he actually read the Wes Gray piece and then decided that he wanted to look at dollar cost averaging and just looking at the market generally. And he actually says that he stole the title from the Alpha Architect piece. So the author is a guy named Nick Majuli. He is, he writes a blog actually called Dollars and Data, which is actually a pretty interesting blog. If you like that sort of stuff, you should check it out. And he's written 2 books now. He wrote a book called Just Keep Buying, and then he wrote another book called The Wealth Ladder. I haven't read The Wealth Ladder, but Just Keep Buying is pretty much exactly what the title says. He goes through a lot of data, which, again, we're going to talk about some of it here, but basically why you're just better off dollar cost averaging. So what he's really talking about, what Nick is really talking about, is market timing, right? So it's human nature, right, to want to try to time the market, right? Because we all know that a crash is going to come, right? And so knowing that the market is going to go down, why not wait and invest when we think the market bottoms, right? And what he says, what he finds, which I think is fascinating, because it's fascinating to me because it's so counterintuitive, is that even with perfect foresight, waiting for the bottom to invest, underperforms. That strategy underperforms. And here's what he says, right? If you attempt to build up cash and buy at the next bottom, you'll likely be worse off than if you had bought every month. And so that's pretty straightforward, but why, right? Why? And it's like, while you're waiting for the next dip, the market is likely to keep rising and to leave you behind. Okay. All right. And so let's look at what you would have done. And so here it is, he's looking at rolling 40-year periods where you'd either buy on the dip. So you buy, at the very lowest point between any 2 highs in the market, or you dollar cost average. And you could see that in the 1920s, in really where you did really well buying the dip was, 1929. Well, that's when the Great Depression happened and the markets crashed. But if you look at more modern times, and when I say modern times, really any time after 1940, buying the dip, has never outperformed dollar cost averaging. And so really buying the dip has never really worked in any of our lifetimes, or most of, I'm pretty sure anybody in this class hasn't worked on any of their lifetimes. And really it only works if there's a massive crash at the very beginning of your investment lifetime. If there's not, you're better off kind of just, like you said, putting money into the market every month. Couple of things to keep in mind is, remember that you have to assume you have perfect foresight. Market rebounds very quickly. So missing the bottom by even just a little leads to worse returns. And so the right strategy is to keep buying. And then I'm going to make a caveat to this, right? And I'm going to make one caveat, which is there are a few times where the expected return from equities, I think, are below bonds. And to me, those are, the real signal that equities are unattractive, because it's all about opportunity cost. And in our lifetime, it's only happened, I believe, a couple of times, right? One was the early 80s, right? What Peter Lynch talked about, when bond yields were very high. Another time was in September of 97, when you look at equity returns and what prospective equity returns were like versus interest rates versus treasuries. And then in the peak of the tech bubble, again, where long-term equity returns were pretty low, reasonable long-term equity returns were pretty low compared to where treasuries were. In 2000, I think the 10-year treasury bond was around 6%. So just to keep that in perspective, we could talk about that in more detail. So let's get to the last reading, and this was one of the readings in The Intelligent Investor, The Investor in Market Fluctuations. This is the only book that was the required text for the class. So I hope you guys all have it and hope you all had a chance to read it. Again, I know it's not necessarily the easiest thing to read because of when it was written so many years ago, but I do think it is something that's important concepts, so it's worth reading. So Benjamin Graham, right? So he's a professor of business at Columbia Business School. He wrote a couple of books. One was Security Analysis and The Intelligent Investor, which is your book. And then he also managed a hedge fund called Graham Newman. And they deliver about a 14.7% annualized return. I think Buffett says that Graham Newman was the first real hedge fund in the industry. Why is Ben Graham really famous, right? He's really famous. He's considered the father of value investing. And, his real claim to fame is he was Warren Buffett's teacher at Columbia. And then, employed Buffett for a couple of years at Graham Newman. So what do we take from this, right? So this chapter 8 is, one of really what Buffett has said, one of the 2 or 3 things that are most important to know about investing. It's really how to think about stock prices. And what does Graham say, right? Graham says we shouldn't let price fluctuations influence our decision-making, right? Market prices really mean little to a real true investor. So he says every day, he introduces this concept of Mr. Market. Mr. Market is a manic depressive business partner of yours. And so every day, Mr. Market tells you what he thinks your interest in a business is worth. And, many times his ideas appear to be completely plausible. But then often, he lets his enthusiasm or his fears run away, and the values he proposes seem silly. And so what Graham says is that Mr. Market is there to serve you, right? And so what he recommends is you should really look at prices, when they're at the extreme ends of a pendulum, right? And he says, you may be happy to sell when he quotes you a high price. So you get a high price, sell your share, and you may be happy to buy when his price is very low. But what and I think this is the most important point, right? You are better off, forming your own ideas of value, right? So you shouldn't let the prices guide your sense of value. You should have your view of value and then try to capitalize on Mr. Market. So prices are really there for you to take advantage of if you choose to do so. And what else does Graham say, right? He said price fluctuations have only one significant meaning for the true investor, right? They provide him an opportunity to buy when prices fall sharply and sell when they advance a great deal. So again, he's basically, in my mind, just saying that you really should only look at prices if you want to take advantage of them, either selling or buying, and then the rest of the time, ignore them. And so he says, Mr. Market is there to serve you, not to guide you. So most of the time, investors should ignore market prices, and he says it, I'm quoting him a lot because I think he says it in such a good way. At all of the times, it would be better if you forget about the stock market and pay attention to the operating results of the company. So really focus on how the company is doing and really don't pay too much attention to what's happening in the stock market. He says a true investor scarcely, if ever, is forced to sell. And, so you can disregard the current price and you only need to pay attention to and act on it if it suits you, right? If it suits your book. So, again, just hammering away at the message that most of the time, most of us should be really ignoring what's happening in the stock market. We should not turn market volatility into a disadvantage. It's really an advantage for us as investors. And what does Graham say? An investor who permits himself to be stampeded, right? Who gets shaken by the volatility, by unjustified market declines, is perversely transforming his advantage into a disadvantage, right? If you get shaken out and you sell when the market is low, you're actually not, you're not acting rationally, right? You should be buying instead of selling, you should be buying instead of selling instead of the other way around. And then, he goes on to say, the volatility, what liquidity means, right? And again, we've talked about liquidity in past classes, is that you have the benefit of the stock market's daily appraisal of your holdings, right? So you have the benefit that you could sell your stock every day, or you could buy your stock every day, but it's only, it's only valuable, whatever you decide that appraisal is worth, right? You don't have to act. And, he goes on to say, right, the investor is able to increase or decrease his investment if he chooses, right? So you don't have to choose to do anything. And, again, like I said, most investors turn volatility into a disadvantage because they're taking their cues from Mr. Market, and Mr. Market is now guiding them instead of serving them. So why do most people succumb to volatility? So I have two theories. One is they don't have confidence in what the actual worth is of their investments. And this reminds me of a quote by Oscar Wilde, right? Nowadays, people know the price of everything and the value of nothing. And I also think that they succumb to volatility because they fear further paper losses. So let's think about the first one, right? And I'll use a thought experiment. So imagine you have a box, and inside the box is $100. And it's not like a valuable box, it's just a cardboard box you got from Amazon. So would you care if someone offered you only $50 to buy it? Right. I hope for most of you the answer is no, right? Because the box has $100 in it. Right. Would you buy an identical box if they offered to sell you one for $50? I hope the answer is yes, right? You should be buying $100 bills for $50 all day long. And then thirdly, would you sell your box if someone offered to buy it for $200? I'd say, again, I hope the answer to that is yes, right? Would you think that they knew something that you didn't, right? No, the answer is no, right? It's a box that has $100 in it. But, when we think about this analogy with investments, right, this thinking ends up getting turned upside down, right? I think these thoughts have probably all gone into our heads, right? Oh, my stock is down. People know something. I should sell before it goes lower. Or, oh, my stock is up. Good news must be coming. I'm going to buy more, right? And so all of a sudden, Mr. Market is no longer serving you. Mr. Market is guiding you. Next week, the topic of next week, we'll go into this in a lot more detail, is really, one of the topics is the limited value of experts. And we'll talk about that in more detail. And I've talked to you already to some degree about, the limited value of sell-side analysts and things like that. So the other point that we said, right, is people fear further losses, right? So what's interesting is, most people are, if you're an investor, you're really a net saver, right? You're saving money, you're investing, and you're not, as Graham said, you're not a forced seller, you're not forced to sell. I will say that, as a general rule from my perspective, I think you should really not invest, you should, money that you might reasonably need over the next 5 years, you should, invest it in, things like short-term treasuries, T-bills, money market funds, things like that. Because the real power of equity investing really comes from being invested in the market for a long time. And we'll see that in a minute. If you are consuming, right, because there might be some people who are retired or nearing retirement. So if you are consuming out of your investments, then I think it's important to have a sustainable withdrawal rate, right? That you're consuming a sustainable amount of your portfolio every year. And we'll talk about that in a minute, right? But there's a pretty well-known sustainable withdrawal rule called the 4% spending rule, right? And it basically says that, if you're retired, you can safely withdraw about 4% from your investments every year for consumption. That number should be indexed to inflation. And if you do that, your portfolio will end up lasting for 30 years. And in reality, the data says that 4% number is actually probably pretty conservative. I think the vast majority of retirees end up with portfolios that are significantly larger, not smaller, when they approach their, at their own death. This is a table that Nick Majuli has on his website. If you're interested, basically it looks at different withdrawal rates for 30 years and different portfolio compositions. And so basically, what are the chances of not running out of money after 30 years based on different withdrawal rates adjusted for inflation? And so what you see here is if your withdrawal rate is low, let's say 4%, you can pretty safely have all of your money in stocks, right? Again, this is based on historical data, but you can see even at 100% stock portfolio, your chance of running out of money after 30 years is basically zero. What you can also see from this chart is that the more, the higher your withdrawal rate is, the more you need equities, right? The more you need higher returns, right? So if your withdrawal rate is 10% and you have a portfolio that's 50% stocks only and 50% bonds, your chance of making it is only 1%. But if you move your portfolio to be 100% stocks, it's still not great, but your chance of making it increases to 24% because you need the higher returns that equities provide to have a fighting chance. But I think the bigger takeaway is really, this table, what it does is it, again, emphasizes in my mind at least, the importance of investing early, building up a nest egg, and then number two, making sure that you keep your lifestyle costs reasonable relative to your assets, whatever those assets may be. So let's go back about, the fear of further losses, right? So one thing that does force you to care about unrealized losses is leverage, right? I'm a big proponent of not needing to use leverage, right? So margin calls force you to sell at the worst possible time, right? It's forcing you to sell probably when you should be buying. And so if you're using leverage to juice your investment performance, my only advice to you is, please maintain a level of prudence. The other thing I will say is that, there's been a wide plethora of new quote unquote investments that have hidden leverage, right? So derivatives have hidden leverage, and then more recently a lot of funds, a lot of leveraged ETFs have come out where you're not necessarily leveraged, but the ETF you're buying is investing with leverage. And again, in some ways you run the same risks. And the thing I think is also interesting about volatility is it really causes people to lose sight of the long term. So we all, kind of talk about having a long-term perspective, and then we run into the teeth of a volatile market, and we kind of tend to forget about certain things. But I do want to kind of emphasize, and we'll look at it, right? The chances of losing money over the medium term is pretty low. The other thing about market volatility, right, and this is more of a behavioral thing, is people tend to feel paper losses more than paper gains. So, they've talked about, there's a lot of studies in behavioral finance about things like loss aversion and things like that. But, losing $100 feels a lot worse than making $100 and things like that. So before we get into some numbers, I think there's a couple of other interesting things I want to talk about. Dead investors outperform. It's a little bit of a joke, but not really. Basically, what I'm trying to say is that people tend to look at their portfolios too frequently. So Fidelity's never confirmed this, but the rumor is that Fidelity did an analysis of their brokerage accounts, and the best performance came from people who had either died or who had forgotten that they had an account with Fidelity. But it seems to make sense, right? Because there is a lot of evidence that people who look at their statements less, they trade less, and they tend to do better. And trading less fits with what we talked about in the first week about the market being a loser's game. In a loser's game, if you don't recall, right, most active decisions are wrong. So if you set it and forget it, you may actually end up doing better in the long run. So I thought this was, I put together this analysis. I thought it was pretty interesting. I call it Rip Van Winkle, the investor. So how would Rip Van Winkle view the stock market, right? And so if you slept for any 5 years since 1970, 88% of the time, he would wake up richer. If the portfolio is down, it would only be down about 5%. And if the portfolio was up, it'd be up by about 84%. In this analysis, it's a 13% annualized return. And the worst that Rip ever did was he woke up and he was down 11%. And that's if he put his money in 1999, the very, kind of the peak of the tech bubble. And he woke up 5 years later in 2004 after the crash had happened. Now, if you slept for 10 years, 96% of the time you wake up richer. And again, this is since 1970, right? The only time you ever lost money was when you invested in the tech bubble. So you went to sleep at the very best of times and you woke up in the GFC, the very worst of times. And in that case, your portfolio was down 11%, right? But all the other times that he woke up and he made money, his portfolio is up 210%, about 12% annualized return. And if you slept for a full 15 years, he never sees his portfolio value go down. And his portfolio is up on average about 400%, 11.3% annualized. So there he is. He's having a very nice, restful sleep under the tree, not worrying about the market. In reality, what I'm trying to say is, hopefully you keep this in mind when, we go through these short-term periods of volatility, like what we're going through, or, what happened on Friday and things like that, where we might be happening today is that, the markets are short-term volatile, but, I think most of us would like to, see our portfolios up 400% over, over many years or more. And so really, what the whole message is just to keep keep your eye on the long-term picture as best as you can. So going back to Graham, he says basically markets are volatile and we need to accept it. And he basically says the same thing that Lynch says, is that, effectively that volatility is the price that long-term investors must accept, right? And he says the investor may well resign himself to the probability that his holdings will advance, say 50% from their low point and decline a third or more from their high point in the next 5 years. So he's basically saying, yeah, the markets are volatile. Your portfolio might go up 50% from the low and then decline by 33%, and that'll happen within the next 5 years. Graham goes on to say that, we shouldn't try to time the market. So similar to the comments that Lynch made, similar to the comments from Nick Majuli, market timing really isn't worth it. He says it's far from certain that the typical investor should hold off buying until low market levels appear. Because, and I think this is important, he says the same thing, right? He says, because it may involve a long wait, the loss of income, and missing of investment opportunities. And so he goes on to say that it's better for an investor to do his buying whenever he has money to put in stocks, except when the market is higher than can be justified. So, but he's basically saying is you should just do dollar cost averaging. And then the last, I think the last thing he says is don't get overly excited with increases or decreases, right? An investor with sound stock should expect their prices to fluctuate and should be concerned by declines or become excited by advances. And he says, we should remember that quotations are there for our convenience to be taken advantage of or ignored. So let me just recap, right? Prices are going to fluctuate significantly. Even the largest companies, their stock prices are going to move around a lot, and this volatility is going to happen every year. And the underlying business value probably is not, you can pretty much guarantee you is not moving nearly as much as the stock prices. And really the best thing to do is sit tight and do nothing. Market timing really isn't worth it. As we saw, missing even a few good months significantly reduces your returns. And even if you can avoid volatility, you're not better off after taxes than just staying invested in the market. And if you're trying to wait for a crash to invest, you risk losing out on returns if the market keeps going up. And so, the right strategy is to invest when you have cash available. Third, bonds, again, on rare occasions make sense. I think for most of us, the only time they make sense is when yields are higher. And I'm talking, and again, I just want to be very clear. I'm talking here about long-term bonds, not short-term bonds, but for long-term bonds, the only time is when their yields are higher than the expected return on stocks. If you, again, like I said, if you need cash in the near term, you probably want to be in short-term bonds. You can be in T-bills, you can be in money market funds. And if you're a retiree, if you have a sensible withdrawal rate, you can still have, pretty confidently have an equity-heavy portfolio. Most of the time, we should mostly ignore the market. We need to hang tight with our investments, kind of repeating what I've said before. We need to have the confidence in the value behind our investments. That's the key to hanging tight. And so developing that confidence is where we're going. We're going to be talking about that over the next couple of classes. And so when we think about what really is a bull market, I think about this really as a bull market. I like to think of really the market as more of a bull in the sense that it's always trying to shake off the weaker hand. So, is that cowboy, is he going to get shaken off or is he going to hold on tight? So really I think that's the way when someone says a bull market, at least that's the way I hope you guys start to think about what that really means. So let's go next week. We're going to talk more about delving into adopting, what I think is the right mindset. There's a couple other things I just want to talk about, the psychology of investing. We're going to talk specifically about what handicapping really means, the value, or really what I would argue the lack of value of experts, and our ability, or really our inability to forecast the future. so next week we have, more readings than we have this week. We have 5 or 6. One is called Chris on Value. Everybody's an expert. Noise. It's time for market forecasters to admit the errors of their ways, and nobody knows anything. The good news is that I think they're all pretty easy to read, and they're all pretty short. So it probably won't be a lot more reading than you had this week. So, anyways, I think this went pretty well, and that's the end of my comments. So as I promised, I'll leave time for the questions. What I'm going to do is I'm going to ask everyone if they have questions. First of all, I hope you do have questions. Is that, ask one question at a time so everyone can get their questions in. I'm going to repeat the questions just to make sure that everyone can hear them. And then if you have any more questions, get in line. But I'm going to stop the share right now and go right to the questions. And I see Wesley has his hand up. So first one's to Wesley.
Thank you, Jay. I was going to ask, even just from the reading this week, it really tells us, hey, look, don't be a complete quant. Don't make just systematic decisions. Try to read the room, in some sense, the psychology of everybody involved and well, making the decision of Mr. Market. Is there going to be a session where you're going to include maybe all the rule of thumbs that you think an intelligent investor should have? Is that something that's going to be included before the end of all different sessions?
Just so again, I'm gonna try to paraphrase it just to make sure everyone hears it, but I also want to just make sure I'm understanding the question correctly. So you're asking, say it again. You're asking like, what are the rules of thumb?
Yeah, I'm asking are we gonna have like Jay's sheet of rules of thumbs that you think have some merit as to have in your quiver as an investor?
Yeah. So basically, we're gonna talk about, and it's really, in my, so I think there's really one great rule of thumb. And, we're going to talk about it. One of the classes I think we've entitled like Buffett's Secret Weapon. And it basically, what I think is most interesting is just how he evaluates investments. And I think there's a lot that we can learn from Buffett. And frankly, if we had, his long-term performance, I think we'd all be very, very happy. So, there's, again, like I said at the very beginning, right? This is not a class where I want to go into in depth on things like accounting or financial statement analysis. Again, I'm happy to answer those types of questions, but really, I wanted to take this at more of a multidisciplinary, high-level perspective. And so, and we are going to be doing case studies at the end of the class, right? So we will kind of see more of this in action. But I think the biggest thing, Wesley, that I think, at least I see a lot is that there's too many people who think that there are real rules of thumb when it comes to investing, right? Because too many times, the markets themselves are complex and adaptive. And, what at the beginning before class started, we were talking about it. And, I think if there was just a cheat sheet of successful investing, everyone would be using it and then, it would completely go away, right? I think I'm trying to remember, somebody once said, right, if all of the secrets of investing were in books, right, the richest people in the world would be librarians. I think it's a joke, but obviously it goes to the fact that like there is no guaranteed formula for investing. What I do think there is, though, is I think there's a guaranteed formula for rational investing. And you may not come up with maybe the highest or, you may not become world famous or anything like that, but I think you'll have good returns, you'll manage your risk, you'll sleep well at night and things like that. But again, like a lot of it will come down to the things that we've talked about, right? I think the biggest thing is just understanding behavior, right? Active investors, real successful active investors act rarely, right? That's the lesson from week 1. the lesson from this week that I hope you all took away is the fact that we have to learn to adapt to volatility and not get shaken out, right? Everybody or most everybody ends up getting shaken out, right? That's why when we look at how stocks fluctuate from their highs to their lows, we see these stocks and and these are, like I said, these are these are the largest companies out there, and they're fluctuating, in many cases 100%. How many people out there say that they, study these companies, really understand them? Nobody's out there putting up 100% returns every year, right? And that's probably because they don't have the real confidence in understanding it. So, what what I think we'll see, 2 weeks from now, we're going to talk about margin of safety and intrinsic value, but we're going to talk about them in very tangible ways. And I think if you really kind of get the confidence that you're investing with a margin of safety and you have a good sense of, reasonable intrinsic value, you'll have that confidence to stay invested. But really, what I hope is that, every time we're going through these periods of volatility, like I said, like we are right now, you'll go back and you'll think about things like Rip Van Winkle and really think about, okay, let me not, maybe not look at the stock market every single day, or let me step back and look at the bigger picture and realize that I don't need to do anything, right? Remember that investing is a loser's game and that most actions are wrong. And so really kind of put a pause on taking action that, may end up hurting you over the long term versus helping you.
Thanks, Jay.
So there's
Yeah.
no, let me just summarize, right? There's no rule of thumb per se, but hopefully these are all kind of mental frameworks that will help you, help you in your investing journey.
Really, what I've been hearing for a couple of weeks is really learn how to distinguish the noise versus the signal. That's really, from a volatility perspective, from like that's what I'm seeing from all the readings so far.
Yeah. I'm not sure who had their hand raised next, so I'll just go in order. David, were you next? Or
I was the last one, so let the others go first.
oh, okay, fine. Okay, so then Christina, maybe I'm looking at it the wrong way. Christina.
Sure, I'll go for it. A quick question here, actually. So I think the concept of DCA is pretty straightforward based on all the readings, at least in theory. Whether we can do it or not is another question. But nobody has covered in terms of DCAing your capital, like over what period of time and what cadence. Like, let's say I have $1 million for the sake of simplicity. And
Yeah.
we deploy that $1 million into the market. What is the methodology of DCAing? Is it like within a 1 year period of time and then investing back in the market every single month on a day during 1 year? Like, over how long is the
I mean, in reality, the way I think it is if you're sitting on capital, you're better off just putting that capital into the market today, right? So, okay, so first of all, let me stop back and just make sure everyone heard the question. I think what Christina's question is nobody talks about the pace at which you should invest your money in. And so how do you dollar cost average? What's the pace? That's right, Christina?
Yeah, like
Okay.
basically is for how long, and then during that duration, what's the
Right.
cadence?
What's the cadence of investing? And so,
Yeah.
So again, I think the point is that most investors have, they're regularly generating income and regularly having savings. And so, when people are talking about dollar cost averaging, what they're really talking about is taking that monthly number and investing it in the market and not trying to time the market. If you were sitting on, let's say in your example, $1 million today, most people would say that you should just put the $1 million into the market today, right? And not like feel like you need to like spread it out over some period of time. Most, for some people at least, that might be mentally hard to do. And so, maybe you say like, okay, I'll invest it kind of gradually over, 2 months, 3 months, 6 months, some period of time. But in reality, the point is that you really want to have your money, especially, you know, on a long-term basis, start working for you right away and not keep it out.
And on that question, therefore, how should one rationalize what Buffett has right now in his portfolio, 30% of cash, and why is he not investing and just putting in the S&P 500?
Yeah, I mean, I think, you know, this was asked, I'm trying to remember, I think somebody asked a similar question last week or 2 weeks ago. I don't necessarily have a great answer for you. I think that one is, you know, he grew up in a time where, you know, he's never really invested in just the index. And so I think if he was investing in an index and he became an index fund investor, I think partly it's just, you know, he's probably looking at it as from a reputational legacy perspective. I think partly he's also looking at it from a perspective of, you know, Berkshire Hathaway is a large operating business. You know, having cash gives them the opportunity to maybe buy things that you wouldn't otherwise be able to buy in the stock market. You know, he just bought the chemicals business from Occidental Petroleum, right? And so, you know, I think that is partly probably it. But to some degree, I think that, you know, he grew up in a time when the market was very different, right? And you did have a lot of these crashes. And, you know, you have to remember he started investing at a time when index funds didn't even exist. And so to a lot of it, I think it's, you know, to a large degree, I think it's like old dogs learning new tricks. And, you know, it's hard for people to do that, right? But I don't have a particularly great answer now.
Can I add, Jay, my understanding about that issue? My understanding is that if he puts in the S&P 500 and if you discount with the like opportunity cost, the net present value is 0. And if you put in the say into T-bills and discount it with the cost of like T-bills, and then you come with the net present value 0. So basically, it doesn't enhance the value of the Berkshire Hathaway. That's why he puts cash rather than on the S&P. That's my understanding.
Yeah, I mean, when we talk about Buffett, and we'll look in more detail, right? Like I think Buffett, you know, you know, pretty much nothing in the market today, you know, would meet Buffett's guidelines for investing in equities, whether it's single equities or if you're looking at the S&P as just an agglomeration of all the equities together, and you just think of it as one giant corporation or one giant conglomerate. You know, I think he just has a hard time because none of these things fit like his exact, you know, his exact kind of criteria for investing. So, you know, when you know, Wesley was asking about rules of thumb, you know, we'll talk about what I think his rule of thumb, right? He's never explicitly come out and said what his rule of thumb is, but I think we can piece it together and we will. But I think that's a large part of it. And so, you know, holding cash, you know, in T-bills is really sort of his default option.
Another reason my understanding is that most of the money is coming from the insurance flow, and he loves to keep that in the cash because he wants to meet the obligation of the insurance in any time. That's my
I mean, he's always said that he'll never go below, I think, $20 billion because he'll always keep that amount. But you know, the question is, why does he have $300 billion? Anyways, Joel, are you next?
Yeah, sure. Well, sure. I'll take a shot. Well, first of all, I read that he said that when he dies, he'd advise his wife to invest her money in the S&P 500 ETF. So
yes, he has said that. Yes, he has.
Yeah.
He's definitely said that.
Yeah.
So the question is, why doesn't he do it now?
Well, because I'm assuming he thinks he can do better. You know,
Yes.
And he's waiting for those opportunities. My question for you is in addition to everything you're going to teach us today, while you say you're not going to focus on analyzing the financial statements and so on and so forth, when you do your investing, do you do modeling? Do you analyze? You know, you'll pick out some stocks of interest and do your modeling and analyze your financial statements before you make your investments?
Yes, I mean, okay, so yes and no. What I end up doing, Joel, mostly is I don't try to model the future. I look at how the company has done in the past, and I look
Right.
at what the company is doing now, and then I use that to try to make a very rough, informed guess of whether or not I think something is an attractive investment.
Got it.
And
Right.
in a lot of ways, what I will say is I think, and again, you know, have a little bit of patience, but we're getting there. But I think what you'll see is, what I think you'll see, or what I hope at least you'll get from the next class, is really how unpredictable the future is. And so, everyone is trying to do these complicated discounted cash flow analyses and things like that to try to come to the precise calculation of what something is worth. And I think you end up kind of fooling yourself most of the time. And when you invest in a way where you're investing with a real margin of safety, you understand the general characteristics of a company, meaning that, do you think the company's going to be around or not? And things like that. You don't have to be as precise about what the future is going to hold. You just need to, again, I know I'm sounding a little bit vague here, but, when you're buying a good or growing business at, kind of bargain basement prices, you don't really need to worry as much about how exactly the future is going to evolve and, introduce a lot of this false precision into your analysis.
Right.
So
Right.
we'll
Yeah, it's hard
we'll talk
to-
about it in more detail, but I actually think that a lot of people end up fooling themselves with this, and I mean, people talk about it as garbage in, garbage out, right? You can make your valuation say whatever you want to say, and it's human nature to kind of, you're doing all this work and analysis, and you want to have some end result out of it, right? People don't want to do all this reading and analysis and then come to the conclusion that, every stock they looked at is fairly valued. So
But I
they
guess
tend to loosen their.
So
they
I
tend to
agree.
loosen their
I
discipline.
wouldn't look at the future either, because who knows what the future is. But you'll look at the historical. You'll evaluate the company, their financials from historically to see if it's a good company. I guess is
Yeah.
that fair?
No,
Yeah.
no, for sure. And again, I think when we look at, again, like I said, we're going to do, we're going to have one class where we're going to kind of look through all of, or most of Buffett's investments in kind of very extensive detail, or as much detail as he's provided. We're going to do a big, in-depth just on Coca-Cola.
Okay.
We're going to be talking about it at that point. But the point, Joel, my point is that I think that what we should learn, and what I think is doable, is it's possible to invest successfully without needing to go through all this detailed analysis of what we think the future is going to hold. And
Right.
yes, maybe we're going to miss out on tremendous opportunities where companies, are complete hockey sticks, where the past has absolutely nothing to do with how their future looks. But hopefully there's enough other investments where, missing those doesn't really hurt you.
Right. Thank you.
Of course. MD.
My question is, from the lecture, what's my understanding is, the reason we cannot time the market because always the ups and downs are following each other. Am I right?
Well, I mean, I think what I was trying to say is a couple of things. One is like, we think we know what the future holds, and we just don't, right? I think if you had looked at, or if you had asked most investors, in April of this year when Liberation Day happened, would the S&P or would the NASDAQ be up as much as it is today? I don't think most people would have thought that, right? And so, so the markets always tend to surprise people, right? You know, again, I don't remember who said it, but somebody once said, right, markets exist to make the most number of people look stupid. So everyone, you know, 2 years ago, everyone thought, you know, we were going to be in an inflation spiral. You know, I think if you'd asked a lot of, you know, Wall Street strategists, we would have had a recession by now. You know, the Trump tariffs were going to cause massive inflation, massive unemployment. And the point is that, you know, markets just don't behave like that. You know, the point about volatility clustering is that, you know, you have both the good months, the best months, and the worst months all tend to happen right around the same time. And if you miss, you know, both the best and the worst months, you know, you're really no better off than just staying put, right? They tend to cancel each other out. That's history. Maybe the future will be different, but, you know, over a long enough period of time, I think there's good reason to believe that that's the case. I said, you know, if you could figure out exactly how to avoid just the bad months and not avoid the good months, right? So if you avoided March of 2020 and then got right back into the market in April of 2020, you know, and if you could do that over and over again, you would be better off. You should market time at that point. It's just I don't think anybody has that ability, right? If you do, like I said, please let me know. I'd love to invest a lot of money with you. So that's really the point about why market timing, from the way most people talk about market timing, to me just doesn't make very much sense. Now, I did make a comment, right, which is I do think that there are times, and again, it's been very rare, but there have been times where the reasonable returns from where equities are not competitive with where bonds are. And bonds are, you know, you have less volatility, usually you have less risk, you know, and things like that. And I think when the returns for equities become so thin relative to bonds, and again, I'm talking from an opportunity cost basis, you know, that's really when you probably would want to be at least a little bit more careful about maybe putting more money into the stock market. But, you know, when we look at, you know, let's just use the example that Lynch gave, right? And what he says is that, well, when bond rates were, you know, if today the S&P is at, you know, 1% dividend yield, you know, you're really talking about treasury bonds above 7%, right? So what I think he's effectively saying, and we'll talk about this, you know, 2 weeks from now, is, you know, you probably want to assume around 7% equity returns from where we are today. Is that great in the historical context that, you know, you made 9% or 11% or 13%? No, like who'd want to make, you know, 7%? But is 7% still better than 4%? Absolutely, right? So you know, and there's other ways to go about it, MD. You know, I think you can look historically at, you know, what is the earnings growth of, you know, the S&P 500, and it's, you know, roughly around 7-8%. So if you take a 7 to 8% earnings growth number, and that number, you know, tech boom, tech bust, housing boom, housing bust, AI boom, AI bust, or AI bust hasn't happened yet, maybe happens. It doesn't really deviate that much from 7 to 8%. So if you take a 7 to 8% earnings growth number and you add 1% in for a dividend, right, you're talking 8 to 9% returns. Again, maybe they're lower than historical average, but they're not drastically lower. And then, you know, the point that you might say is, well, what about the multiple? Maybe the multiple goes down, right? But the longer time that you use, and again, you know, maybe the S&P is today at 25 times earnings, maybe you think it should be 20 times earnings or whatever, but the longer time frame you use, the less that is as a drag to your total returns, any contraction in the multiple, if you think contractions happen. And so again, you're, you know, rough numbers, maybe you're at 7% instead of 8% or 8% instead of 9%. But again, you know, what else are you going to do, right? What's your opportunity cost, right? Your opportunity cost is, treasuries at 4.5%, maybe investment grade bonds at 5.5%, right? Over time, you're not going to do better than equities even now.
So what do you think the money managers they cannot take this volatility? I see that if the stock is in 1 year, they're like 50% around like the up and down
Sorry,
situation.
so MD, can you just get back in the line, because I see there's some
Oh,
other
sorry,
people, but I
sorry.
just
Yeah.
want to be
Yep.
sensitive to time.
Yeah.
Judy, are you next or is David next? I think Judy, maybe you and then David.
Okay.
And then I'll circle back to you, MD, and then Joel.
Thank you. I have a quick question. What is your perspective on finding investments based on recent headlines? So, for instance, last Friday's Trump threats on tariffs. Immediately I was thinking, okay, there's there's a restriction from China to export these rare earth minerals, and that means there's a shortage, and maybe it's a good opportunity to buy into companies that are supplying these minerals in the US. So my question is that speculating? Or is that actually thinking of investment, like good thinking to find good investments?
I mean, I don't listen, I don't think it's wrong, right? I mean, again, I also would tell you, right, that, these are things that, especially when you're thinking about things that are man-made or politically driven, right?
Mhm.
They can change on a dime, right? Like you may buy some US rare earth company today because you think that, we're not going to get rare earths from China. And, tomorrow, there might be a tweet or, a Truth Social post or whatever saying that we've come to a deal and this and that. And then all of a sudden, like, it changes right away. And, the market will change. I mean, these stocks are super volatile, right? The markets will change very quickly. And the way markets react is they react in, they react very fast. So as soon as you saw like this whole fight about rare earths, partly these companies are small and speculative and things like that anyways, right? I mean, these stocks all shot up already, right? So, I guess what I'm gonna say is, what do you think that you have, do you have a real, if you have a real informational advantage, then they might be great investments. And if not, like, how are you gonna get in before everybody else, and how are you gonna get out after everybody else? And so I really asked that question to yourself.
Yeah, thank you. That's helpful.
Yeah.
I didn't invest. Someone was just telling me about it, and I was like, oh, I'm not sure. I don't know anything about it. Usually I look at just companies. So this is really good confirmation that shouldn't just go with it.
Yeah. Yeah, I mean, again, and maybe this is my own personal bias, but I think one of the reasons you want to look at companies that have history is because, hopefully that history has been proven and tested over many different political administrations, many over different economies, different economic cycles, things like that. And, companies that have long track records, tend to have more real businesses that aren't, maybe artifacts of, politics or trade wars or things like that, where they can do really well, and they can also, go away very quickly. David?
Similar question, but first, this is probably the best I've ever heard in volatility. So thank you very much for that.
Aim to please.
I want to find out what you were thinking on this day, April 9th of this year. So I want to let you know I'm going to be the example of the wrong thing to do for everybody, but some people can probably relate. So on April 9th, I think it was a few days after Liberation Day, and it's the morning right before Trump says like today's a good day to invest in stocks in a tweet, and then he put the 90-day delay in implementing these 100% tariffs. But the morning of, before any of this happened, I said like, 100% tariffs, the rest of the world is not going to stand for this. They're going to, do the same thing to us. The earnings for all these companies is going to go down. I think it fundamentally changes everything. In my mind, this is what I'm thinking. Trump is very unpredictable. I was thinking that there was nothing like this during his first term. I don't know what's going on. And for my previous experiences from 2009 and 2000, I checked over everything. We're down about 20%. It was pretty much a bear market. And I was thinking, like, this doesn't feel like the bottom to me. And I remember when markets went down 40 or 50%, it says that we could only be halfway down. So I did sell. When he announced those things later on, I was thinking, like, well, still he could change his mind. Something could still happen. So I didn't get back in right away. Um, but anyway, what were you thinking on that day or that week? Because you probably remember, because it was pretty momentous.
Yeah, I remember.
that
I
week.
remember. It wasn't that long ago. My kids will say I have a bad memory, but it's not that bad. So I mean, look, it was obviously a very unpredictable time, right? And again, when we talk about like, the convention being broken, right? People had very significant uncertainty about what would happen, in the future, right? Would the whole world just go into a giant trade war? Would everybody start retaliating? Would everyone just accept these tariffs? Would these tariffs, would the tariffs go from 100% to 200%? Like, who knew? And then what would that do to inflation? What would we put ourselves in a massive recession? These are all concerns, okay? And I don't want to make it sound like these aren't rational concerns. These are all absolute concerns. But, when you think back, right, the difference is this was a man-made crisis, right? When you think about things like COVID, right? COVID was really more of a, more unpredictable in a lot of ways, right? We shut down the entire economy, right? We didn't know at the very beginning, right? We didn't know if there'd even be a vaccine, we didn't know how lethal like COVID was going to be and things like that. And even then, when you look at how bad or how unpredictable that was, like this was one where you knew that like, there were ways, there were off ramps, right? Meaning, cooler heads would prevail. Again, I think one of the things that a lot of people understand is also that this administration is sensitive to things like, where the stock market is trading or where interest rates are and things like that. And so if you really saw things start to get really bad, there was always a view that, you would figure out ways, maybe politically to ease back and things like that. But, but I think the bigger point, David, is that all of these things may happen. And it might be painful, but again, if you're not really forced to sell, you're not really living off of your investments and things like that, all you've really lost is value on paper, right? But it's just a paper, it's a paper loss. It actually it actually might have created better opportunities for you to buy, companies for the long term, right? Because at some point, Trump may not be president, different things may happen, things like that. And, some of the best investments you would have been able to make might have happened, if the trade war had actually gone on longer, right? So again, but my point being is that when you step back and you think about these things, the one thing that I would say, and again, I think history tends to prove it out, maybe the future will be different, is that we tend to adapt, right? Like we figure out ways to adapt to different things, right? I remember right after 9/11, right, people were like, oh, we're not going to fly, we're not going to travel. And, within a short period of time, right, people were flying again, right? We adapted. I think that at a certain point, if we hadn't found a vaccine for COVID, we would have just said, okay, we have herd immunity, or we're going to live with it, or we're going to wear masks, or we're going to figure out something, because we're not going to leave, we're not going to like leave our economy permanently shut and things like that. So, would tariffs have been bad? Yes. Would we have figured out maybe different supply chains or figured out ways to, manufacture here, or, adjusted prices, or I don't know. The answer is I don't know. I think we would have adapted. And I think that the beauty of corporate America is you have every incentive to figure out a way to adapt, right? Because all the markets are there for your taking and things like that. So I think companies would have tried to figure out new and interesting ways to do things. So yeah, it was absolutely a scary time. But I think when you step back and you look at the long-term picture and you think about like, okay, like, is this worse than like the tech bubble and the tech crash and the GFC and COVID, and how long did it take to recover from those kinds of things? Like, it's not really that significant, right? The other thing I would say is, we tend to not have a great perspective of how big or how long it might take for markets to recover. Because obviously, markets recovered a lot faster than I think people expected at the time. But, when you really think about it, right, let's say, the market is down 20%, right? Even if you thought it would take 2-3 years, right, maybe the end of this term before anything changed, right, and the market was down, let's just say the market was down 50%, right? But at some point, you knew that you would regain that. And if you regain that 50% over 3 years, 4 years, 5 years, right, you're making 10% plus returns, like, on top of, whatever the companies may be themselves growing, you kind of say like, okay, that's actually an opportunity. It's not a risk, right? So I don't know if that was clear, but, again, I think the point is that it behooves us to always remove ourselves from what's happening immediately, take a step back and look at the long-term chart and understand the long-term picture more than anything else. The funny thing is that when you show somebody the long-term chart of the stock market and you ask them to pick out like bad days in the stock market, like Black Monday and things like that, they can't even see them, right? Like when you really zoom out, you don't see, you don't even see like, you don't even see things like some of these really, what seem like really terrible times. But when you're living it up close, obviously you do. And so the whole point is to say that, we don't want to get shaken out of our plan. And so the way I believe that you don't get shaken from your investing plan and maintain a lot of rationality is having, keeping the long-term perspective in mind. And then, like I said, later on, right, really understanding things like intrinsic value and margin of safety, because that will give you a real grounding where most investments don't necessarily have a grounding.
Yeah, what do you mean by long term and the medium term? Like how long you think is the long term and how long is the medium term?
So how long is the medium term and how long is the long term? I mean, I as a rule, I generally think 5 years is the medium term and 10 years is, 10 years and longer is the long term.
So Jay, on the week of April 9th, to become more like you, on a scale of 1 to 10, were you like a level of 2 of concern? It was just like a fly buzzing and you're just swatting it away, or how concerned were you?
To be honest, I was looking for things to buy more than
Yeah,
things to sell.
super. That's what you're supposed to do. Awesome.
Yeah.
Well,
But David, listen, part of that is, like I said, I have the, a little bit of it is just developing that, the gray hair, those investing scars, right? Like I said, I remember, and I look back, I was selling stocks. I was selling things in my portfolio at the very bottom of the GFC, and I remember the tech bubble and all that, and really succumbing to a lot of the, the fears, but then, also seeing how the markets, recover over time. And, it doesn't seem intuitive to us, right? But, the funny thing is that if the market were to crash 50% today, most of you guys would be better off if that happened. because you probably have more of your investing future ahead of you than behind you. And, you know, it's hard to think about, but the way compounding works, and, you know, think about, like, you know, the ability for companies to buy back their own stock and grow earnings and things. Obviously, when the stock price is lower, they can grow faster. But, you know, we don't realize it, but, you know, in retirement, you may actually have more money if the market were to crash today than the other way around. And I'm not talking about, you know, just because you could time the market and things like that.
Thanks, Jay.
Yes.
Joel?
Well, last question for me is, you talked about Wes Gray, an alpha architect. So I read his book a while ago, and he's got a couple of ETFs, a momentum and a value ETF, and a few others. And without you know, asking you advice, because I know you're not giving investment advice, I wouldn't ask that. But do you think I'm assuming you think his thinking is sound on his methodology for his value and momentum methodologies are sound?
Yeah, again, with the caveat that I haven't read all his papers, so I don't know everything.
Yeah.
But, you know, I think generally the answer is probably yes. I mean, I think he's probably, I mean, I'm pretty sure he has a PhD in finance and stuff like that. So
Yeah, he does.
he's a lot smarter than I am. So I have no reason to doubt any of his analysis. Like I said, I came across, you know, his paper about God and, you know, getting fired as an active manager, and I read that. I thought it was a very interesting analysis I'd never thought about. And it just, you know, it to me, it just emphasized the point that, you know, here we are, we want to be active investors. We want to buy, you know, everybody wants to buy, you know, the next NVIDIA or whatever. And, you know, even if you could pick out what the next NVIDIA is going to be, you just have to realize that, you know, it's still going to be a very bumpy ride along the way, getting from point A to point B. You know, we should be ready for that. And that was the point of that. But I will profess ignorance. I haven't read all of his other research, so I don't know. But if you point me to something specific you have a question about, I'm happy to answer it.
Okay.
In Canvas.
Okay, thank you.
MD?
I know you don't recommend leverage, but do you recommend when the market is like falling, say 25 to 50%, then you go for leverage and buy more, or you don't, or you think that's also a very risky strategy?
I mean, personally, you know, I just don't ever see the need for leverage because, you know, to me, MD, the biggest problem with leverage is sometimes it forces you to do the wrong thing at the wrong time, right? The market might be down 40, 50%, still doesn't mean it can't go down more. And, you know, if it goes down and you get margin called, you know, you lose whatever stock you may necessarily have had. And in reality, you're selling when, you know, maybe the right thing to do should be buying, right? You want to be buying more if the price went lower. And so I just don't like the fact that leverage forces you to worry about, you know, the path dependency about investing, if that makes sense. It's also why I don't like shorting stocks, right? Because again, when you short stocks, you know, you may be completely right about a stock going to zero, but you may lose all your money first, right? Because it might go up, right? There was a company in Europe called Wirecard that was a massive fraud. And, you know, everybody who was right about Wirecard, you know, still ended up losing all their money because, you know, the stock went up a lot first, right? Or, you know, Volkswagen, you know, was, you know, at one point was a giant short squeeze, and at one point was the largest company in the world because of the short squeeze. And so again, people were right about, you know, maybe Volkswagen not being worth what it was worth, and they still lost all their money. And so, you know, just because the market goes down 30, 40, or 50%, yeah, it's down a lot, right? I don't necessarily know that it can't go down more, especially in the near term, right? Because markets can do, you know, all kinds of things, right? Liquidity dries up, you know. I mean, hell, even if nothing happens, right? We have things like flash crashes. If a flash crash happens, and that's just because of some, you know, computer outage or something like that, and you get margin called, you know, right at that moment, right? You know, you're losing your investment instead of making the money you should be making. So,
What is flash crash?
huh?
What is flash crash?
Oh, there was a period of time in the or there was a day, again, I don't remember, now it's been years ago, where, you know, something happened in the stock market and all the computers stopped working, and, you know, stock was quoted at 100 and then was quoted at like $1 like the next moment. And people tried to buy, people panicked and were selling. It was all kinds of nonsense. I think the exchanges ended up just kind of canceling all those trades that happened. But, you know, you had stocks that were down 50%, and, you know, just because of some, I think it was a computer glitch or something like that.
So why do you think that the money managers, like, since the stocks, like you have shown, like this volatility is like 50% roughly around lots of the stocks, that is still not performing better, because what's the reason behind it?
What you're saying, what's the reason why active managers aren't performing better given the volatility of stocks?
Yes.
Well, because I think it's really what Benjamin Graham was saying, is that they don't look at volatility as advantage, right? They become slaves to the volatility, and they panic, right? You know, again, like I said, most active managers have, you know, they worry about career risk, right? Because just because the stock went down, you don't know that it's not going to continue to go down. And if it keeps going down and you really do badly in a time when maybe the market itself is doing okay or doing well, you're going to lose assets. And if you lose assets, you lose your job, you know, you look like a fool, you know, whatever, you know, all the things that Keynes was saying, right? You're, you're going to, you know, the psychological aspects of it, right? Like, I mean, every one of these companies, you know, again, you look at NVIDIA, right? NVIDIA went down to $90, right? Because people thought that when China and DeepSeek came out, they said, oh, it's the end. We don't need like more GPUs because we figured out a way to make LLMs cheaper, right? Google was trading at $150 and now is at 200 and whatever dollars, right? But when it was at $150, the narrative was ChatGPT is going to destroy Google search, and, you know, the business is going to completely go away, right? I mean, those are just two examples, but the problem is that when you are managing money and you can't disprove that narrative. And so people say, like, okay, well, you know, again, what we were talking about before, right? Like, active managers are really concerned about what they think how the stock is going to perform. They're not really even thinking about where they think the business is going to be over the long term.
For us, like small investors, like in that circumstances, how would we know that the business is going to turn around and go up? Like, how? Like, there's any way to figure it out?
Well, again, I think you can have a good idea of what businesses are, you know, where businesses are likely to be. But, you know, look, let me be very frank, right? If you look at most stocks, and if a stock is trading at 20 times earnings and it, you know, goes to, or 25 times earnings and it goes to 20 times earnings or something like that, right? What does that mean, right? Okay, the stock was at 25 times earnings, now it's at 20 times earnings. Was 25 expensive and 20 cheap? Was 25 cheap and 20 cheap? Like, it doesn't tell you anything, right? And
Yes.
the reality is most of the things are just, you know, they're trading on these levels, and you don't know where other people are going to come in and buy them, right? What you can look at, though, right? And again, you know, this is where we're going to get to, is what you can look at. You can say, well, where does it have to get to at a level where I don't need anybody to buy it from me? You know, again, we're going to talk about this in 2 weeks, right? Where is it 16 times earnings? Is it 10 times earnings? Is it 12 times earnings? Where, the earnings itself are enough to provide you a return, and maybe you don't need growth, or maybe, you don't need other things to make a reasonable return, as long as you think the business isn't going away, right? So the reality is most of these things, most stocks right now are ping-ponging between prices where, if Nvidia trades at, 50 times earnings and was trading at, 30 times earnings, I don't think you could say necessarily that either of them is a completely no-brainer price. And, just because it was trading at 30 times earnings, you don't know that it's going to go to 50 times earnings versus 20 times earnings, or 5 times earnings, or 10 times earnings, or whatever. And so that's the problem, right? The problem that investors have is at any price that something is trading at, they still don't know if it's going to go up or down from there. And that's why they panic.
So the way you think, like say, whatever the net cash flow means, like the cash flow I don't need for the business to run, I can give away as dividends. That cash flow, and you compare with the price, and if you see that price and that cash flow could be paid out as a dividend, makes sense compared to the like bonds, then you think, okay, it's a good price and we should not be panic. And if we think like the future of the cash flow will remain same, there is no business problem that can deteriorate, then it's a good price to buy. That's my understanding from your conversation.
Yeah, I mean, look, I'll just, what MD is saying is basically, is there a price where, stocks trade where you can feel confident in just the value? And I think the answer to that is yes. And again, we're going to be getting there in, 2 weeks from now. But basically, I'll just say this right now, right? If you told me about a company today that is growing, it doesn't have to be growing fast, but it's growing, and it's trading at, let's say, 10 times earnings, 10 times free cash flow, something like that. So really 10%, if they paid out their earnings, they, could pay you a 10%, hypothetical dividend, and that business is growing. Yeah, I'd feel pretty safe buying that, right? But if it was something that was trading at 10 times earnings and, maybe was declining, you'd be maybe a little bit worried about that. So, really the question is, and again, these are all topics we're going to talk about, but, the real question is like, what are the ones where you can feel confident about? And that's really the concept of where margin of safety and intrinsic value sort of all intersect. And like I said, just bear with me because we are getting there.
So how to avoid in that circumstances the assumption of loosening your assumptions and justifying the price? Like,
well, that's where it's hard for most people to sit still, right? And I think that's where, at least, if you don't see something that meet your strict criteria, you could always, like I said, you could always be just investing passively in the meantime and things like that. If you have, you have money you want to invest every month and things like that, and you don't see specific stocks, and you feel like you have to have something to do and you want to participate in the market going up, because it does go up over the long term. That's where I think passive investing really comes in.
some of the examples you gave last week, one example is like Meta, the way it turned around and it went up. So how do you know like this business is gonna turn around and it's gonna go up? There is any way
You don't listen. Okay. So MD's asking a question of like, the example I used last week of Meta and how, you knew that Meta was going to turn around. The frank answer is you didn't know for sure, right? You absolutely didn't know for sure. But you had at least some sense because they'd faced challenges in the past. And you also had some sense because the business was still growing, right? People were worried that the business was going to stop growing, and in fact, it never stopped growing. But no, you didn't know for sure. right? But the other thing is it also traded at a level where you didn't need it to grow. You didn't need it to turn around, right? At the bottom, Meta traded at like 12 times earnings, right? And so, 12 times earnings meant that, they could take their earnings and pay it out to you. And again, you don't know this for sure, but at least the data was showing you, or at least the history would tell you that the business had not stopped growing. And they could have paid you something like an 8%, an 8% dividend. And that's, there's all kinds of things we can go into about, they weren't even maximizing their earnings and this and that. There's a lot of expenses and stuff. Maybe we'll talk about Meta in the last class in more detail, but you didn't know that for sure, right? But it was probably a better bet at that point than a lot of other things. And like I said, just because something trades at 12 times earnings doesn't mean it can't go to 10, but at some point you have to say, like, these numbers are pretty attractive.
Another example you showed last week, like bankruptcy, like that one business was turned around from the bankruptcy. How did you know like that would be turned around from the bankruptcy and the price would go up?
So, okay, I realize what the time is, so this is gonna be the last question, and then just send me the questions over, send me the questions, any remaining questions through Canvas. I just want to be sensitive to everyone's time. Again, you can look at, again, I think this is where having a little bit of knowledge about what the businesses do, but you don't know this for sure, right? You never know it for sure. You could just have a very good idea of certain things. Like, look, if a company is going bankrupt, you don't know how their calls, how their negotiations are necessarily going with their banks or whoever their lenders are and things like that. But usually, most lenders don't want their companies to go bankrupt. Most companies don't want to go bankrupt. And so if there are solutions outside of bankruptcy, most people will take them. And so I think you generally see it in some cases. But again, this is where you need to have some level of domain knowledge. I'm not saying you have to be a complete expert, but I would not recommend just going and buying every company that you thought is going to go bankrupt, because probably most of them do go bankrupt. So anyways, send me the questions. I'm sure there's people who have more questions. I think I see a couple more in the chat, but I just want to be sensitive to everyone's time. I love these questions. These are great. I wish I'll try to make the comments, the lecture part of it, maybe even a little bit shorter, so I can leave more time for questions. But like I said, the great thing is we have Canvas, so everyone can submit questions over Canvas, and if I don't answer them right away, I'll usually answer them in a day or two.
Thank you very much. I really appreciate it.
Okay, good talking to everybody. Thank you. Have a great week, and like I said, send me all your questions. Look forward to it. Thank you. Bye.